Investing in unit trusts can be a great way to achieve diversification and professional management of your investments. By investing in a unit trust, you can gain exposure to a broad range of securities, which helps to spread out your risk. The fund is managed by experienced fund managers who conduct thorough research to identify investment opportunities and make investment decisions based on the objectives of the fund. Here are the top 10 ways to invest in unit trusts. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Number 10. Through an exchange-traded fund. Investing in unit trusts through an exchange-traded fund (ETF) can be a convenient and cost-effective way to gain exposure to a diversified portfolio of assets. An ETF is a type of investment fund that is traded on stock exchanges, and it holds a basket of securities such as stocks, bonds, or commodities. ETFs that invest in unit trust funds are also available, which means that investors can gain exposure to a diversified portfolio of unit trusts through a single ETF. This is a convenient way to invest if you want to build a diversified investment portfolio without having to buy and manage individual unit trusts. ETFs also offer flexibility, as they can be bought and sold on stock exchanges throughout the trading day. Additionally, ETFs typically have lower fees compared to other investment options, such as mutual funds. However, it is important to understand the risks associated with investing in ETFs, such as market risk and liquidity risk. Number 9. Through a tax-free savings account. Investing in unit trusts through a tax-free savings account (TFSA) can be a tax-efficient way to build your investment portfolio. A TFSA is a type of registered account that allows you to earn tax-free investment income, including interest, dividends, and capital gains. This means that any investment gains you earn in your TFSA are not subject to income tax. Many banks, investment platforms, and unit trust fund managers offer TFSA accounts, and you can choose a TFSA that suits your investment goals and risk tolerance. Investing in unit trusts through a TFSA can also offer flexibility, as you can withdraw your money at any time without incurring any tax penalties. Number 8. Through a regular savings plan. Investing in unit trusts through a regular savings plan can be a disciplined and consistent way to build your investment portfolio over time. A regular savings plan allows you to invest a fixed amount of money at regular intervals, such as monthly or quarterly. This is a convenient way to invest if you want to make investing a habit and don't have a large lump sum to invest upfront. Many investment platforms, banks, and unit trust fund managers offer regular savings plans, and you can choose a plan that suits your investment goals and risk tolerance. Regular savings plans may also offer lower fees compared to other investment options, and you can benefit from dollar-cost averaging, which means you buy more units when prices are low and fewer units when prices are high. Number 7. Through a direct investment plan. Investing in unit trusts through a direct investment plan can be a straightforward and convenient way to invest. Direct investment plans allow you to buy units in a unit trust fund directly from the fund manager. This is a convenient way to invest if you want to bypass intermediaries, such as financial advisors or brokers, and have more control over your investments. Direct investment plans may also offer lower fees compared to other investment options. However, it is important to do your research and choose a reputable unit trust fund manager that is regulated and has a good track record. You should also ensure that you understand the fees, charges, and risks associated with investing in unit trusts before making any investment decisions. Number 6. Through a workplace retirement plan. Investing in unit trusts through a workplace retirement plan can be a convenient and efficient way to build your retirement savings. Many employers offer retirement plans such as 400 and Onyx, and these plans often allow employees to invest in unit trust funds. This is a convenient way to invest if you want to save for retirement and have access to a retirement plan through your employer. Workplace retirement plans often offer tax benefits, such as tax-deferred contributions and potential tax savings on investment gains. Employers may also offer matching contributions, which can help boost your retirement savings. However, it is important to understand the fees and charges associated with investing in unit trusts through a workplace retirement plan, as these can affect your returns over time. Number 5. Through an investment platform. Investing in unit trusts through an investment platform can be a convenient and cost-effective way to get started. Investment platforms offer access to a wide range of unit trust funds, and you can compare funds, read research reports, and make investments online. This is a convenient way to invest if you want to manage your investments on your own and want to save on fees. Investment platforms typically charge lower fees compared to traditional financial advisors or banks, which can help you save money in the long run. However, it is important to do your research and choose a reputable investment platform that is regulated and has a good track record. You should also ensure that you understand the fees, charges, and risks associated with investing in unit trusts before making any investment decisions. Number 4. Through a bank. Investing in unit trusts through a bank can be a convenient and accessible way to get started. Many banks offer unit trust funds, and you can typically invest through your bank's online platform or through a financial advisor at the bank. This is a convenient way to invest if you already have a relationship with the bank and want to consolidate your financial accounts. Banks typically offer a range of unit trust funds from different fund managers, so you can choose a fund that aligns with your investment goals and risk tolerance. However, it is important to do your research and compare the fees and charges associated with different unit trust funds before making any investment decisions. Number 3. Through a Robo Advisor. Investing in unit trusts through a Robo Advisor can be a convenient and low-cost way to get started. Robo Advisors use algorithms to provide automated investment advice and portfolio management. They can help you identify suitable unit trust funds based on your investment goals, risk tolerance, and financial situation, and manage your investments on your behalf. This is a convenient way to invest if you want to save time and do not have the expertise or resources to manage your investments on your own. Robo-advisors typically charge lower fees compared to traditional financial advisors, which can help you save money in the long run. However, it is important to do your research and choose a reputable robo-advisor that is regulated and has a good track record. Number 2. Through an online broker. Investing in unit trusts through an online broker can be a convenient and cost-effective way to get started. Online brokers offer access to a wide range of unit trust funds, and you can compare funds, read research reports, and make investments online. This is a convenient way to invest if you prefer to manage your investments on your own and want to save on fees. Online brokers typically charge lower fees compared to traditional financial advisors, which can help you save money in the long run. However, it is important to do your research and choose a reputable online broker that is regulated and has a good track record. You should also ensure that you understand the fees, charges, and risks associated with investing in unit trusts before making any investment decisions. Number 1. Through a financial advisor. Investing in unit trusts through a financial advisor can be a convenient and helpful way to get started. A financial advisor can provide personalized advice and help you identify suitable unit trust funds based on your investment goals, risk tolerance, and financial situation. They can also guide you through the investment process and provide ongoing advice and support. Financial advisors have access to a wide range of unit trust funds and can provide research reports and analysis to help you make informed investment decisions. They can also monitor your investments and make adjustments to your portfolio as needed. Investing through a financial advisor can be a good option if you are new to investing, or if you prefer to have professional guidance and support. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.